The 8 lessons of the book, The Intelligent Investor. #1. Value research and the importance of investing for the long term. Investigating value consists of buying assets below what they are really worth. That is, the real value of the action must be higher than the price you pay for it. According to Graham, it is best to invest in companies with a PER of less than 10. The PER, price-earnings ratio, is nothing more than the relationship between the share price and the profit of the company. Therefore, the PER is obtained by simply dividing the share price by the earnings per share. In the book, Graham explains that the smart investor is not one who seeks short-term profit, but one who invests for the long term. Investors must do extensive research to find stocks that are undervalued but have growth potential. For that, he must analyze the companies and their balance sheets to find out if they will be profitable in the long term. After buying the shares, he must wait as long as necessary until the market realizes the real value of the company so that the investor can obtain good returns when selling them. Hence the importance of investing in the long term, since in the short term the stock market can undervalue the shares and you will end up losing money. 2. Speculator versus investor. Graham explains that it is essential to make a clear differentiation between speculation and investment. The investor considers himself the owner of a company and therefore wants it to be a profitable business and tries to make it profitable. The investor does not mind waiting to earn money on the stock market. On the contrary, the speculator seeks to make quick profits without caring in which company he puts his money. When speculating, if you are wrong, you can get disastrous results and lose a lot of money. The author explains that it is preferable to obtain long-term secure results than to try to get money quickly by speculating. Graham defines an investment as an operation that, after careful analysis, promises security and an adequate return. According to this definition, in order to classify an operation as an investment, it must include exhaustive analysis, security, and an adequate return. 3. Passive investor versus active investor. In the book, 2 types of investors are described: the passive, or defensive, investor and the active, aggressive or enterprising, investor. Passive investors are those who focus on avoiding losses or serious mistakes. They don't want to spend a lot of time selecting assets and try to make as few mistakes as possible. On the contrary, active investors spend a lot of time and care looking for the best options to invest in for a good return. According to Graham, if they are patient and put in the effort, they can turn out to be above market profits. Throughout the book, Benjamin Graham explains which options are best for each type of investor, as he obviously will not invest in the same way as a defensive investor as an aggressive investor. 4. The importance of knowing the stock market. The stock market is unpredictable. He is constantly moving between pessimism and optimism. Therefore, Graham says that it is essential to know the phases of the market to be able to invest with peace of mind. The author explains the behavior of the stock market through the figure of Mr. Market, a manic-depressive character with constant mood swings. When Mr. Market is in a good mood and very optimistic, he wants to sell shares at a very high price. On the contrary, when Mr. Market is feeling sad and pessimistic, he sells them below his value. Graham explains that the smart investor knows how to take advantage of Mr. Market's mood swings and buy stocks when he's pessimistic and sell them when he's optimistic. The author also recommends not selling shares at the slightest sign of a crisis, as the market always recovers. 5. Safety margin. As we saw earlier, Benjamin Graham says that it is preferable to try to take advantage of stock market errors rather than to try to guess its movements. Although it is inevitable to lose money when investing in stocks, the smart investor should ensure that the loss is not excessively large. That is precisely why he only recommends investing if there is a sufficient margin of safety. The margin of safety is the difference between the market price of the stock and its intrinsic value. That is, by buying stocks that are undervalued, you make sure you don't lose a lot of money. The cheaper a stock is, the greater the margin of safety you get. In this way, you protect yourself from stock market fluctuations and possible mistakes that you may make. Number 6. Learn to diversify. Graham is adamant, do not invest all your capital in a single stock, even if it is very promising. If you stick to stocks of just one company, you risk losing everything if the company does poorly. That's why Graham recommends diversifying and investing in different stocks and mutual funds. The book explains that you should never have all your capital invested in stocks, but it is advisable to diversify between bonds and stocks. Generally speaking, he says that an investor should never have more than 75% invested in stocks, with the rest invested in bonds. This is probably the most controversial point in the entire book, since it has been empirically shown that bonds are less rewarding than stocks in times of bull markets. So a buy and hold portfolio with 25% permanently invested in bonds is probably not the most rewarding strategy out there in the long run, although it does give you peace of mind, especially if you're a conversationalist. Number 7. The investor and inflation. Inflation consists of an increase in the prices of goods and services during a certain period of time. According to Benjamin Graham, the smart investor can protect himself from inflation by buying stocks. The author says that inflation is limited to silently stealing our wealth. The success of an investment is measured by analyzing what remains of our assets after a period of inflation. The greater the return offered by the investment, the greater the value of our assets and, therefore, the more successful the investment will have been. Since stocks of carefully chosen companies are a potentially highly rewarding asset, it is one of the best ways to hedge against inflation and grow your wealth, despite the existence of inflation. Number 8. The investor and investment funds. Graham explains that the higher the return of a fund, the more barriers to entry it will present to the investor. In addition, he remembers that past performance is not a guarantee of future performance. It is worth mentioning that Graham did not recommend investment funds because in his time they had very high entry costs or were closed to the general public. However, as Jason Zweig comments, today that reality has changed, entry fees are much lower, in some cases practically zero, and investment funds closed to the public are in the minority, although some of the most important and successful of the world, such as those of Bridgewater, by Ray Dalio, continue to be so. That being said, in my humble opinion, if you are just starting to invest in the stock market and you don't have the time or the knowledge to carry out such an exhaustive analysis of hundreds of companies as Graham recommends, I believe that the best solution for you will be to invest for the long term thanks to ETFs, traded funds.